Hi everyone, I'm Russell Muldoon from the Montgomery Fund and welcome to this week's Video Insight. Well, reporting season is in full swing and all of us here on the investment team are extremely busy trying to keep on top of the news flow. We've reviewed every single company report out so far and have had numerous meetings and one-on-ones with company management in the past few weeks. And while it's still early days, we think there are a number of points worthy of us briefly mentioning today. All of us here have gone through many reporting seasons in the past, and perhaps what is most surprising from this season is the lack of reports from companies announcing what we would consider high quality results and bright prospects early on. Usually from the first week of August, if you really want to be noticed by the investment community when there's a bit of a lack in terms of reports, then this is the time to release your result. And generally during the early days, what we have seen in the past is a steady flow of companies with quality results jumping ahead of the rest. This has not been the case this year. Whilst we have seen some of the usual candidates like Credit Corp announce early, a large number that we would have expected to report now have, for whatever reason, chosen to delay their reports until the bulk reporting season hits this week. We have a saying at Montgomery based on our experience that those reporting last in the midst of everyone else are doing so in an attempt to hide their result and outlook. While this might be a case of generalization, and it probably is, in our experience, generally this is the case, and we have suspicion that the results we are going to see and have seen this year are not really going to live up to the standards of the past few reporting seasons. Another point worth mentioning is that we are again seeing similar sectors this year show the strongest performance and growth metrics overall to those last year. Internet-focused businesses such as car sales and realestate.com.au have again reported well. Telecommunication businesses in Amcom and Big Air generated excellent results and growth outlooks. Healthcare businesses with overseas earnings such as Ansell and Sonic have beaten market expectations, and despite the doldrums being reported constantly by the media, retail businesses such as JB Hi-Fi and The Reject Shop are trading very, very well. A few days ago, and as we do each year, we had the pleasure of sitting down and catching up with the CEO of The Reject Shop and CFO Darren Briggs, who were again very generous with their time post the release of their financial report to give us a thorough update on how they think the business is travelling. What we came away with is a feeling that in the coming years, this is a business with bright prospects and perhaps one you should have on your radar. If you don't know the story, a key competitor to TRS was an unlisted business known as the Retail Adventures Group, a group of discount variety businesses which has reportedly had a number of issues recently, and you can go into the press and see a number of articles on this. This has and will be a huge tailwind for TRS, as it's thrown up a very short-term window for TRS to grab a number of sites from the current incumbents. These incumbents are discount variety stores which have, for example, gone broke and ceased trading. A number of these sites have been in the watchful eye of TRS for many, many years. And by way of example of the opportunity that lies before them right now, a number of sites that were interested in Tasmania would have 3 years ago cost them $30 million to acquire. In the past few months, noting the issues with Retail Adventures, they've effectively walked into these stores, taken them over, rebranded them the Reject Shop for next to nothing. That's an exciting prospect for any business owner or investor. And this is just one tailwind. This is happening all over Australia for TRS, and what we think is worth focusing on now is that just over a 2-year period, which includes the financial year just gone and also 2014, the year coming, TRS as a business will have opened 80 to 100 new stores. That's equivalent to 35% growth in their store numbers in just 2 years. $67 million in incremental capital being invested in what has historically been a high return on incremental capital business. 40 of this is for CapEx, fixtures and fittings, IT and DC infrastructure, 20 million in inventory, and 7 to layer on additional management to manage this growth. These are very long-term attractive reinvestment metrics which we are excited about. Whilst we do expect short-term pressure on the business's profitability as they absorb and fully expense opening costs, stores will take time to mature, lots of new staff and will be required to be adequately trained to manage these new stores. Longer term, the growth of the business's momentum is impressive, and should management be able to execute the growth plan perfectly, we expect very strong profit growth in 2015 if beyond, if they pulled out pull it off without any issues. We of course own the Reject Shop shares, and you must of course do your own research before even considering also purchasing the shares. We are just noting the fact that the years ahead for the Reject Shop look very bright for the business, and we fully expect our investors will be rewarded in time. Well, that's all for me this week. Remember to check out the blog for daily insights from our entire team, and please continue to follow us on Facebook and Twitter for regular updates. Have a great week.